Something strange is happening beneath the surface of the market that most investors don't see. The investment strategy that worked reliably for decades is being quietly transformed by a force that didn't exist when that strategy was developed. The rules are changing while most people continue playing by the old ones. I noticed it gradually at first. Small anomalies in how markets behaved, patterns that didn't match historical experience, correlations that seemed too tight, movements that felt synchronized in ways that organic markets shouldn't be. Then I started digging into the data. What I found explained the anomalies but created new concerns. The market that millions of people depend on for retirement has become something different than what they think they own. The strategy they trust has developed vulnerabilities that didn't exist when they adopted it. Today, I'm pulling back the curtain on how artificial intelligence is quietly reshaping the stock market. Not the stocks of AI companies, though that's part of the story, the actual structure and behavior of the market itself. How concentration has reached levels that create hidden risks, how feedback loops amplify movements in ways that distort reality, and what you can actually do to protect yourself while still participating in market growth. This isn't fear-mongering. I'm not predicting imminent collapse. I'm showing you what's actually happening so you can make informed decisions rather than trusting a strategy that may no longer work the way you assume it does. The foundation of modern retail investing rests on a strategy that seemed to solve the complexity problem. The S&P 500 index fund became the answer for people who wanted market returns without the expertise required for stock selection. Buy all 500 companies at once. Capture overall market growth. Don't try to pick winners because most people, including professionals, can't do it consistently. This approach worked brilliantly for decades. Spreading money across hundreds of companies reduced risk that any single failure could devastate your portfolio. The diversification smoothed returns and protected against company-specific disasters. The math supported the strategy historically. Markets rose over time despite periodic crashes. Patient investors who held through volatility eventually saw their accounts grow. The simple approach of buying the index and waiting outperformed most active management strategies that charged higher fees for worse results. I recommended this approach for years. I still believe the core principle is sound. Broad market exposure with low costs beats complex strategies for most investors most of the time, but something fundamental has changed in how this strategy actually works now versus how it worked when it earned its reputation. The diversification that index funds are supposed to provide has quietly eroded. The S&P 500 is market cap weighted, meaning larger companies constitute larger portions of the index. This made sense when the largest companies were perhaps 2 or 3% of the total each. The weighting reflected economic reality without excessive concentration. That's no longer the situation. A handful of mega-cap technology companies now constitute an enormous percentage of the entire index. The top 7 companies alone represent close to a third of total index value. The top 10 push even higher. This means buying the S&P 500 today isn't really buying 500 different companies with roughly equal impact on your returns. It's buying a handful of giant tech companies with 490 others along for the ride. The diversification that made index investing safe has been mathematically undermined. You might own 500 company names, but your actual returns depend overwhelmingly on what happens to perhaps 10 of them. This concentration didn't happen randomly. It happened because of a specific technological development that has captured investor imagination and capital flows. Artificial intelligence has become the dominant force driving valuations in the market's largest companies. The technology giants that dominate the index are all making massive investments in AI. They're building data centers, training large language models, developing AI products, and integrating AI into existing services. They're spending billions annually on infrastructure required for AI development. The stock market has responded by valuing these companies based not on current earnings, but on expectations about future AI dominance. Investors are paying premium prices for companies positioned to lead in AI, regardless of whether that leadership has actually produced proportional profits yet. This creates a market increasingly dependent on a single technological trend. The companies aren't just large because of diverse business success. They're large specifically because of AI expectations. If those expectations prove correct, the concentration might be justified. If AI delivers the transformative value currently priced into stocks, the companies leading its development should indeed be enormously valuable. But if AI development takes longer than expected, or costs more than anticipated, or fails to generate profits matching the investment, the concentrated market becomes extremely vulnerable. A single trend disappointing could devastate portfolios that seem diversified. The situation is complicated further by how these companies are financing their AI expansion. Many of the technology giants are borrowing substantially to fund AI infrastructure. The capital expenditure required for data centers, chips, and development runs into tens of billions annually per company. Some of this comes from operating cash flow, but significant portions come from debt. This debt-financed expansion works well when interest rates are low and growth expectations remain elevated. It becomes problematic when either condition changes. Higher borrowing costs pressure balance sheets. Disappointed growth expectations reduce ability to service debt profitably. Systemic risk emerges from multiple giant companies making similar leveraged bets on the same technology at the same time. If AI disappoints broadly, the concentrated index faces multiple simultaneous pressures from its largest components. This isn't the diversified, resilient market structure that made index investing safe historically. It's concentration on a scale that creates fragility. The dynamics create feedback loops that amplify the concentration further. Here's how the loop operates. Passive index investing has become enormously popular. Trillions of dollars flow into index funds automatically through retirement contributions and automatic investment plans. When money flows into an S&P 500 index fund, the fund must buy stocks in proportion to their index weighting. Larger companies receive larger purchases. This buying pressure pushes their prices higher. Higher prices increase market capitalization. Higher market capitalization increases index weighting. Increased weighting means even more of the next dollar flowing into the index goes to these same companies. Their prices rise further. Their weighting increases more. The bigger these companies become, the more passive investment they receive. The more passive investment they receive, the bigger they become. The loop feeds itself continuously. This creates market strength that appears genuine but may be partially artificial. Prices rise not because business fundamentals improve, but because structural money flows push them upward automatically. The feedback loop can mask weakness. Even if underlying business metrics disappointed, continued passive inflows would still push prices higher. The market could appear healthy, while fundamentals deteriorated beneath the surface. Eventually, feedback loops reverse. When prices finally fall enough to trigger selling, the same mechanical forces that push prices up accelerate the decline. The passive selling pressure mirrors the buying pressure. The concentration that magnified gains magnifies losses. Understanding this dynamic changes how you should think about market performance. Strong index returns recently don't necessarily indicate strong economic fundamentals. They may partially reflect structural flows into concentrated positions. Alternative index structures exist that address concentration risk, though each involves trade-offs. Equal-weighted index funds give the same importance to every company in the index regardless of size. Each of the 500 companies receives roughly the same allocation rather than weighting by market capitalization. This eliminates concentration. The top 10 companies have the same impact as any other 10 companies. No single sector dominates based on market cap inflation. The diversification that index investing is supposed to provide actually exists, but equal weighting creates its own challenges. To maintain equal weights, these funds must regularly rebalance. When certain stocks grow faster, they must sell those winners to buy underperformers. This selling can reduce returns if winners continue winning. The constant rebalancing also creates trading costs and potential tax consequences. Each trade incurs expenses and may trigger capital gains. These costs reduce returns relative to buy and hold approaches. Market cap weighted funds allow winners to keep growing without forced selling. This can capture momentum more effectively. The reduced trading keeps costs lower. Neither approach is universally superior. Market cap weighting works better when concentration eventually proves justified. Equal weighting works better when concentration eventually reverses. Your view on whether current tech valuations are sustainable should inform which structure makes more sense for your situation. Considering both approaches rather than defaulting to market cap weighting alone at least recognizes the concentration risk rather than ignoring it. Geographic diversification provides another dimension of protection that most American investors neglect. The overwhelming focus on American markets ignores investment opportunities elsewhere and concentrates risk in a single country's economic and political circumstances. Historically, economic dominance shifts over time. The country leading global markets in one era often cedes leadership in subsequent eras. In 1900, the British market dominated global investing. The British Empire's economic power seemed permanent. Investors concentrated in British securities believed they owned the centre of global commerce. Over the following decades, that dominance shifted. American markets grew more important. Investors concentrated solely in British securities missed the growth that occurred elsewhere. In the 1980s and early 90s, Japan appeared ascendant. Japanese stocks reached valuations that seemed to reflect inevitable economic supremacy. Investors concentrated in Japanese markets believed they were positioned for continued dominance. That expectation proved devastatingly wrong. Japanese markets declined for decades while other markets grew. Concentration in Japan produced poor outcomes regardless of the quality of individual company selection. American markets have led for the past several decades. This leadership feels natural to investors who have only experienced this period. It seems permanent. The assumption that American dominance continues indefinitely feels safe because it's all most current investors have known. But historical patterns suggest caution about assuming any dominance lasts forever. Economic leadership has shifted repeatedly across centuries. Assuming current conditions represent permanent reality ignores this history. Global diversification addresses this uncertainty. By spreading investment across multiple countries and regions, you position to benefit regardless of where growth actually occurs. You're not betting on any single country remaining dominant forever. Global funds automatically rebalance exposure as relative economic importance shifts. When emerging markets grow faster, their allocation increases. When developed markets struggle, their allocation decreases. The rebalancing happens automatically based on market reality rather than requiring prediction. This doesn't mean avoiding American markets. American companies remain important. The point is, reducing concentration in any single geography, just as reducing concentration in any single company is prudent. Thinking about the market in terms of distinct zones helps clarify where different types of opportunity and risk exist. The first zone I think about is what I call crowded territory. These are the large cap, heavily analysed, intensely competitive positions where institutional investors crowd together. The mega-cap technology stocks that dominate the index occupy this zone. Crowded positions aren't necessarily bad investments, but the crowding itself affects dynamics. Everyone owns them, everyone is watching them. Price moves trigger responses from countless other holders. Volatility can spike quickly. Information advantages are nearly impossible because so many sophisticated analysts cover every detail. The AI-related positions exist primarily in this crowded zone. The companies investing billions in AI are the same companies everyone already owns through index funds. Adding specific AI stock exposure often means doubling down on positions you already hold indirectly. The second zone is defensive territory. These are stable companies generating consistent cash that prove resilient during economic turbulence. Utilities, consumer staples, certain healthcare companies, businesses whose demand doesn't disappear during recessions because their products remain essential regardless of conditions. Defensive positions often lag during strong bull markets. Their stability feels boring when everything is rising. But that stability becomes valuable when conditions deteriorate. They fall less during crashes. They continue paying dividends during downturns. They provide portfolio ballast that reduces overall volatility. The third zone is speculative territory. These are small companies, often unprofitable, riding hype about potential rather than demonstrated results. Many AI-adjacent startups occupy this space. Big promises, small revenues, stock prices disconnected from current business reality. Speculative positions can produce enormous returns if the speculation proves correct. They can also become worthless if it doesn't. Position sizing matters enormously. Speculative exposure should be small enough that total loss wouldn't significantly damage your overall financial position. The fourth zone is what I find most interesting. Undervalued and overlooked territory. Smaller and mid-cap companies with real businesses generating real profits that institutional investors largely ignore because they're too small for large fund mandates or too boring for media attention. This is where I focus attention for AI-related opportunity that differs from the crowded plays. The overlooked zone contains companies actually applying AI practically rather than just spending billions developing it. Businesses that use AI tools to improve operations. Companies leveraging AI without bearing the infrastructure costs that tech giants absorb. Businesses where AI adoption improves margins without requiring the massive capital expenditure that debt finances big tech expansion. These companies fly beneath radar that tracks only the largest names. They don't get media coverage. Analysts don't follow them closely. Passive index flows don't push their prices higher automatically. This neglect creates opportunity. Prices don't reflect potential that careful analysis can identify. Early positions can be established before broader recognition drives appreciation. The undervalued zone requires more work than buying an index fund. You must actually research individual companies, but the potential returns justify the effort for those willing to do the work. Strategic hedging provides protection against scenarios where concentrated markets decline sharply. Diversifying into global stocks addresses geographic concentration. Positions in international developed markets and emerging markets reduce dependence on American market conditions specifically. Smaller company exposure through small cap and mid cap funds addresses size concentration. These companies don't have the same index weighting dynamics inflating their prices. Their returns depend more on actual business performance and less on passive flow mechanics. Gold provides a hedge against currency debasement and financial system instability. Central banks around the world hold gold reserves for this reason. Individuals can implement similar strategy on smaller scale. Physical gold provides the most direct hedge but creates storage and security requirements. Gold ETFs provide easier access with lower friction, though they introduce counterparty risk that physical ownership avoids. The percentage allocation to gold varies by individual risk tolerance and outlook. Some people hold none because they see no scenarios where gold proves valuable. Others hold significant allocations because they see monetary instability as increasingly likely. There's no universally correct answer. Cash holdings provide flexibility that fully invested portfolios lack. Maintaining cash reserves allows responding to opportunity during market downturns. When prices fall sharply, having available capital means you can buy at reduced prices rather than watching from the sidelines. Fully invested portfolios cannot take advantage of crashes. Everything is already committed. The crash might present excellent buying opportunities, but without available cash, participation is impossible. Even experienced investors, who typically remain fully invested, have increased cash holdings recently. This reflects recognition that current conditions may be unusual. The potential for volatility creates value in maintaining flexibility. The opportunity cost of holding cash during rising markets is real. Cash earns modest returns while stocks appreciate, but this cost is the price of optionality. You're paying for the ability to act when circumstances change. Liquidity allows seizing opportunities during volatility that illiquid positions prevent. The investor with cash during a crash has options. The investor without cash has only the positions they already hold. Understanding AI opportunity requires distinguishing between spending and earning. The technology giants currently dominating the market are spending enormously on AI. Their costs are definite. Their revenues from AI remain largely prospective. They're building infrastructure hoping that profitable applications emerge to justify the investment. This approach can work. Building capability ahead of demand has powered many technology successes. Being ready when demand materializes creates competitive advantage, but spending doesn't guarantee earning. The infrastructure investments might not generate returns proportional to costs. The AI applications that justify data center construction might take longer to develop than expected. Competition might prevent capturing value even when applications succeed. A different AI investment thesis focuses on companies that earn from AI rather than spend on it. These are businesses that adopt AI tools to improve their existing operations. They use artificial intelligence to reduce costs, improve products, or serve customers better. They benefit from AI without bearing the development cost that technology giants absorb. A manufacturing company using AI to optimize production benefits from the technology without building data centers. A service company using AI to improve customer interaction captures value without training large language models. A retailer using AI to manage inventory improves margins without the capital expenditure that tech companies require. These applications create value for companies that didn't exist before AI tools became available. The improvement flows to their bottom line without corresponding increase in their capital spending. Identifying these businesses requires looking beyond the obvious AI stocks that everyone discusses. It requires understanding how AI actually creates value in practical business applications, rather than just which companies are spending most on development. The companies best positioned might not be labelled AI companies at all. They might be manufacturers, retailers, service providers, or traditional businesses that happen to implement AI effectively. Their AI advantage isn't their identity, it's their efficiency. These opportunities typically exist in the overlooked zone I described earlier. They're mid-cap companies that don't attract institutional attention. They're small-cap businesses below radar that tracks only large names. They're the underdog businesses leveraging AI efficiently, rather than just funding it aggressively. Early identification of these opportunities provides potential for returns that crowded positions cannot match. Wealth builds from identifying early trends rather than following crowds after trends become obvious. When everyone already owns something, the potential for exceptional returns has largely been captured. The price already reflects widespread recognition. You're buying what everyone already knows is valuable. Early identification means recognizing potential before widespread awareness drives prices. It means taking positions while the crowd is focused elsewhere. It means accepting uncertainty in exchange for optionality. AI presents both risk and opportunity depending on positioning. The risk comes from concentration in obvious AI plays that may be fully valued or overvalued. The companies everyone owns as AI exposure might disappoint expectations that are already priced in. The crowded positions face both fundamental risk from AI developments and technical risk from concentrated ownership. The opportunity comes from underdog businesses and mid-cap growth stories, where AI creates value without current recognition. These positions offer potential upside without the concentration risk that obvious plays carry. Being early in backing innovative technologies or applications can lead to significant returns. But early also means uncertain. It means taking positions before confirmation arrives. It means accepting that some early bets will fail. Portfolio construction should reflect this uncertainty. Core holdings in stable, diversified positions provide foundation. Smaller allocations to speculative and early-stage opportunities provide potential upside without risking the core. History provides lessons about concentration and cycles that current conditions tend to obscure. Economic dominance shifts over time. No single country, sector, or technology remains on top forever. This pattern has repeated across centuries with remarkable consistency. The current period of American technology dominance feels permanent to investors who have only experienced it. But feeling permanent doesn't make something permanent. Every previous era of dominance eventually ended despite feeling permanent to those living through it. The British market's dominance ended. Japanese market supremacy ended. The technology bubble of the late 1990s ended despite certainty during its peak that technology had permanently changed market dynamics. This history doesn't mean current conditions will definitely reverse. Perhaps American technology companies will maintain dominance indefinitely. Perhaps AI will deliver on expectations and justify current valuations. Nothing in history requires repetition, but history does counsel humility about predicting permanence. It suggests diversification against scenarios that feel unlikely but have precedent. It recommends avoiding the concentration that felt safe during previous periods that eventually ended badly. Diversification is not prediction. You don't need to know which scenario will occur. You position to survive and benefit across multiple scenarios. When you're right about diversification, you gain moderately. When concentration would have devastated your portfolio, diversification saves you. The asymmetry favors diversification. The cost of being wrong about concentration is potentially catastrophic. The cost of being wrong about diversification is merely modest underperformance relative to concentrated portfolios that happen to work out. Practical action integrates these concepts into actual portfolio decisions. Maintaining a core position in market cap-weighted S&P 500 or total market funds still makes sense for most investors. The criticisms I've raised don't invalidate the fundamental approach. They suggest adjustments rather than abandonment. The core should probably be smaller than conventional advice suggests, given concentration concerns. Rather than putting everything in the S&P 500, allocating perhaps half or 60% to this core leaves room for other positions. Reducing exposure to overly concentrated top companies can happen through equal-weighted alternatives or through selecting specific sectors or positions that don't duplicate the biggest names. International allocation through developed market and emerging market funds addresses geographic concentration. 10 to 20% in international holdings provides meaningful diversification without requiring active management. Small and mid-cap exposure through dedicated funds captures opportunity in the overlooked zone I described. These companies trade at different dynamics than mega caps. Their prices reflect actual business performance more than passive flow mechanics. Gold allocation through physical holdings, or ETFs, provides insurance against scenarios where financial system stress affects paper assets broadly. 5 to 10% provides meaningful hedge without excessive opportunity cost. Cash reserves provide flexibility to act during volatility. 10% or more in accessible cash allows taking advantage of opportunities that market disruptions create. Individual positions in undervalued businesses leveraging AI effectively require more research but offer potential returns that index exposure cannot match. Allocating a small percentage to individual stock selection in the overlooked zone provides upside optionality. This structure maintains participation in market growth while reducing the concentration risks that pure index investing currently carries. It sacrifices some potential upside during periods when concentrated positions continue outperforming. It provides protection during periods when concentration reverses. The trade-off suits investors who prioritize not being devastated over maximizing every possible gain. It suits those who recognize that market conditions have changed in ways that affect how traditional strategies function. What I've described today isn't about abandoning index investing or predicting imminent collapse. The index fund revolution improved outcomes for millions of investors. The core insights remain valid. Low costs matter. Broad exposure beats stock picking for most people. Patient holding through volatility produces results, but the specific implementation of index investing has changed as market structure has changed. The diversification that made the strategy safe has eroded through concentration. The feedback loops that weren't present when the strategy developed now distort price discovery. The AI dependency that drives current valuations creates single point of failure risk. Understanding these changes allows adapting strategy while maintaining the principles that made index investing successful. You can still capture market returns with low costs. You can add dimensions of diversification that pure S&P 500 exposure no longer provides. AI is quietly reshaping markets through concentration effects, feedback loops, and valuation distortions. Recognizing this allows positioning that the unaware investor cannot achieve. Write in the comments how concentrated your current portfolio is in the largest technology companies. Calculate what percentage of your holdings depends on those handful of names. Sometimes seeing the number reveals exposure you didn't consciously choose. Share this with someone who believes their index fund provides all the diversification they need. The concentration might surprise them. The implications might change their approach. Markets evolve. Strategies that work in one era require adjustment for new eras. The investors who recognize this and adapt will navigate coming years better than those who assume what worked before will work indefinitely. AI is changing everything, including how the market itself operates. Now you understand what's happening beneath the surface. What you do with that understanding shapes your financial future. Position accordingly.